Hi, I'm Jimmy. In this video, we're looking at Target stock, ticker symbol TGT. Okay, so first we're going to look at the basics of Target's business, and then we're going to try to come up with a fair value of Target stock using a discounted cash flow valuation method. Now, Target is a very interesting company since they're up more than 90% over the past year, and they have dividend yield of slightly more than 2%. Okay, so let's start with Target's revenue. And as we can see, Target's revenue has been somewhat stagnant or so over the past few years. But then in 2016, after a fairly big dip, Target's revenue started moving higher, and analyst estimates, those are the ones in the green bars, analyst estimates indicate that the Target's revenue could continue to climb for the next few years. So we might ask, what happened to Target's revenue in 2017 that caused this turnaround? Well, in 2017, Target rolled out a big plan to focus on expanding their online presence at the same time as renovating a large number of their stores. Now, this has the potential to be a very big deal for Target since I'm sure we all know, but Target is in an industry that is very, very competitive with companies like Walmart and Amazon. So Target has set out to build a platform where they can make things as convenient as possible for the customer while also competing on the price side of things, which is going to be key if they're going to want to keep customers coming through their doors. Now, along these same lines, Target actually acquired a company called Shipt in 2017. Shipt is a same-day delivery service platform, and now that Target owns them, they're already being utilized to offer a better order fulfillment experience, make shipping faster basically, for their customers. And this brings us to Target's most recent quarterly earnings announcement, where they announced their third quarter quarterly earnings. And after that, this is what their stock did. So clearly, they did quite a good job in this quarter if the stock jumped as much as it did. That quarter, they reported earnings per share of $1.36, which was 25% higher than the previous year and well above analyst estimates. So when we switch over to Target's annual earnings per share, we can see here a very similar story to what we saw with Target's revenue, which was limited growth for this time period. And then, if we believe what analysts are estimating, it looks like earnings per share should have good growth over the next few years. And we can't forget that 2019 only has one quarter remaining in it since the first three quarters are already in the books. So it looks like 2019, they should get fairly close to that estimate. Okay, now this brings us back to Target's stock chart. Now, as we can see over the past year, Target's stock is up a total return of more than 90%. Total return assumes you reinvest dividends as they come in. Now, a lot of this excellent performance is tied to two main things. First, Target is doing a very good job of executing their plan of growing their online presence and upgrading many of their stores. And at the end of the day, this should ultimately lead to a very strong Target business over the next couple of years, which should help revenue, earnings per share, and hopefully for Target shareholders, the stock should move higher. And the second thing that drove a lot of this performance was a year ago, Target's stock was priced a lot better than it is today. So this is Target's price to earnings chart over the past year. And a year ago, Target was trading at about 12 or 13 times earnings. Compare that to where Target stock is now, which is about 20 times earnings. Okay, so now our question is, what do we think Target stock is worth today? And if we wanted to buy Target stock, where should we buy it? What's a good level to buy it at? For that, let's look at our discounted cash flow valuation. Okay, so for this, we have projected free cash flow. For that, I just took analyst estimates. But what I think is interesting is that in 2021, there's an expected drop in free cash flow. And this ties back to the $7 billion omni-channel rollout, which is the upgrading of the stores and their online presence, that whole experience for customers. So far, they're doing a pretty good job of that, but there's going to be a cost tied to that. That's why we're expecting to see a dip in free cash flow. It seems that analysts are expecting, if we look at the following years, for those expenses to pay off as free cash flow should continue to grow from there. Which brings us to this calculation where we used a required rate of return of 8.5%, and I used a perpetual growth rate of 2.5%, which is about in line with what I typically use. And for that, we end up with a fair value of Target's company at $61 billion. that breaks down to about $121 per share. Now, I did a whole video on how to do this calculation. There's an Excel template and all of that. If you're interested in understanding this valuation method better, there's a link in the description below. But for now, let's switch back to Target's stock price chart. And for that, we can see that right now, we projected the fair value to be about $121 per share, which is right about where Target is trading right now. And clearly, we're going to want to pay less than that. We're always going to want to pay less than what we believe the fair value of the stock truly is. And this brings us to my concern with Target stock. So as good as Target appears to be doing and as much potential as they have, I think we can all admit that Target is in a brutally competitive business. Now, I think that they've done a good job of managing debt levels. Whenever we analyze a company, I think it's important to at least get a quick look at debt. And when we switch over to net income margins, well, here's where things get a little bit interesting. Because the retail store business is so difficult, even if it's online, margins tend to be fairly low, leaving any business that's competing in that industry with very little room for error. To put this 2018 net income margins of 3.8% in perspective, just as an example, well, Microsoft has net income margins of more than 30%. And Walmart, which is obviously a better comparison to Target, well, their net income margins are a bit over 2.8% over the past 12 months. So clearly, this is a very competitive industry. Now, we could even make the case that in this industry, that Target is doing better than Walmart because they have better profit margins. But given how competitive this industry is, having the lowest price is very important. So it's crucially important that companies keep their costs very low and their margins ultimately at the lowest acceptable level. And as long as they do that, well, I believe that Target should keep growing and they should continue to be able to pay their dividend and ultimately, hopefully, gain additional market share, which should allow for them to grow if they can continue to execute their plan. Now, assuming that their fair value of the stock is truly $121 per share, what should we pay for it? Well, for me, on a personal basis, I'm looking for about a 20% margin of safety with this type of stock. That would mean that in this case, we wouldn't want to pay anything above $97 per share. So for me, although I like their 2% dividend yield, I'm a bit afraid of overpaying for any stock that I think it would make more sense for us to wait for it to get below the $97 per share. And if it does, we jump in. If it doesn't, we don't. Now, if you're curious where I got the 20% margin of safety from, well, that's really just my personal preference. And I actually did a whole video on when to buy a stock, which ultimately takes a closer look at the concept of margin of safety and gives some simple ways to identify each of our own ideal entry level for almost any stock. So if you're interested, that could be a good next video to watch. I get a link in the description below and right here. Besides that, thank you so much for sticking with me all the way into the video. If you found this interesting, hit the thumbs up, hit the subscribe button. Thank you, and I'll see you in the next video.